So welcome everyone. Good morning, those in North America, and good afternoon, those joining us from Africa and other parts of the world. Today, it's a nice day. It's sunny outside here. I don't know how it is in Dhaka or in New York, but I guess it's nice too. Anyway,
It is.
my name is Enoch, and I'm a founder of African Rebirth. And like just posted and let anyone know about this event. We're going to talk about a few things, but I want to welcome our audience and our panelists in a special way. And the rules of engagement, we will have a panel discussion, and after we'll have a Q&A, and we'll call it a good Sunday. It will be brief. Don't worry, those who have other appointments. It will be so brief, but I think we're going to dive into our panel discussion. So I want to begin by introducing our exquisite panelists. I'll begin from Miss Melissa Cook. She's a member of Bretton Woods Committee, a non-partisan network of prominent global citizens who champion efforts to spur economic growth, elevate poverty, and financial stability. She's also founder and MD of African Sunrise Partners, a New York-based international firm that sources investment opportunities and provides expertise to people doing business in Africa. She's also a former member of a U.S. President's Committee. Her main duties were to strengthen commercial duties between United States and Africa. So welcome, Melissa.
Thank you. Glad to be here.
Good, thanks. Furthermore, we have Miss Isabel Hanucci, if I pronounce your name correctly. She's the founder and MD of Tiranga Trade Company. Now, Tiranga, I researched and I found that Tiranga means welcome in Senegalese local language. So her firm does specialize in providing quality and professional services to the business in doing in China, but also sourcing out to companies that want to invest in China. She's also a founder of We Go to China, special name. We Go to China, where they specialize in HR solutions, sourcing, recruitment, induction, and placements. Her ties to Africa comes as a co-founder of AfriSlate company, providing a special company providing support to African startups and connect them to global opportunities. So welcome, Isabel. Last but not the least, Mr. Fikri Mariam Gitowe. I pronounced your name correctly, sorry. He's a pre-doctoral research fellow at the University of Toronto, specializing in economics. His research specializes in economics between in developing countries, specifically on how economics drives politics. He's a passionate economist and a Pan-Africanist. So welcome, Fikri Mariam.
Thank you so much, Enoch. I'm excited.
All right. So tonight we have a topic. I will dive into the topic directly. How can Africa attract private capital flows to boost its economic prosperity? And I want to dive and tap into Fikri, who's an economist and academician. What's the relationship between private capital flows and economic growth? And would you begin by defining what is capital flows? Simply for us who may not be economists or practicing economists, what do you mean by that? And yeah, you have the floor, Fikri.
Yeah, thank you. Yeah, I think it is important before we go into what the data is telling us and what the evidence is telling us. I think it's important to step back and ask ourselves, why is it that countries would want to lift all these restrictions and impediments on the free movement of capital. Why would a country want to attract capital, first of all, right? And I think there are at least two reasons for that. And one is an argument that you would find in an economics textbook. It's an efficiency argument. It says that if there are no impediments on the free movement of capital, capital will move to places where it has the highest return. In economics lingo, we call it the law of diminishing marginal returns. It's really a fancy way of saying whenever you have a high amount of capital stock to begin with, the return from adding an additional capital is lower than places where there is a lower amount of capital to begin with, right? So if that theory is correct, then what it predicts is that countries in Africa who have a lower amount of capital stock to begin with will have a higher return to capital than countries in the developed world, right? So what that theory predicts is that capital should move from United States and Europe to emerging economies in Africa, in Asia, and Latin America, right? So it's really saying that if you let capital be free, then it will allocate itself efficiently, right? The second argument is that the urge to attract more capital and the fright that it will leave you incentivizes countries to implement the right policies and build the right institutions, right? If you do not get your inflations under control, if your budget deficit is not under control, then capital will not come in the first place, or if it's already there, that it will leave you, right? So that to be able to attract capital and to keep it, governments will implement the right policies and build the right institutions, or at least presumably so, right? So based on these two theoretical claims, a lot of international development organizations like the IMF and the World Bank have been advising and sometimes even forcing a lot of emerging economies, especially in Africa, to open their economies to capital, what you might call financial liberalization measures, right? So for the past 30, 40 years now, we have a good amount of data and evidence to judge if that theoretical claim and those policies that accompanied it have actually worked, right? Before I go into that, there has to be I have to say something as kind of a warning, which is that as economists and really as social scientists, we operate in the real world. We're not functioning in a controlled environment, right? So you cannot, for example, vary capital inflow and then hold everything else constant in the economy and then see if it has resulted in economic growth or what its impact is on economic inequality or financial stability and so on. What usually ends up happening in the real world is that when capital inflow changes, it changes with a whole lot of other things in the economy. Regulatory frameworks change, labor markets change, human capital investments change with it. So it's really hard to be able to disentangle the impact of capital inflows on a whole lot of these things, right? But that being said, there's some kind of stylized facts that have started to emerge from the data and evidence that has been accumulating for 3 decades now, right? The number one thing is that from the perspective of an international investor, the performance of sub-Saharan Africa has been very impressive, meaning that the interest rate, which is like a proxy for the return of capital, has been really high in a lot of these African countries. So if you're an investor and from Europe or America, wherever, and you invest in Africa, the return is high. All right. Part of the reason is it's risky investment, right? So the return has to be higher. And the second reason is what I have already said, which is there's a very low amount of capital stock in Africa, So adding a little bit will have a higher return, right? And the second stylized fact is that because of that, partly because of that, capital has actually been moving to Africa in the past 3 decades. The capital inflow has been increasing in Africa, right? And because of that, the interest rate differential has been declining. They're starting to converge. The interest rate in Africa and the rest of the world starting to converge, right? That's the second stylized fact that's starting to emerge. And the third one is really something that we'll discuss it going forward, which is that unlike our expectations and what the theory would predict, capital inflow in Africa has not brought the economic growth that we expected, right? It has actually been kind of disappointing. The times and the periods and the countries where capital has been flowing in are not necessarily the countries and the times that, you know, growth has been happening, you know? And we'll expand on that as the conversation continues.
Thank you, Fikra, for laying that theoretical background as an academician. So I want you raised 3 important points, like, you know, the important one, like to measure its impact. I want to turn to Melissa. You work in most like been doing like you've been to almost all East African countries so far, but also doing business and advising. What, depending on what Fikra said, what have you seen change? What are the key, has that capital flow worked in? And what are the, you know, relations between like the capital and the prosperity that we are talking about?
Well, it's such, thank you, Fikram, because that was a really, really helpful introduction, very thought-provoking. And what I'm seeing is actually the opposite in a lot of cases. So, you know, I've spent my career doing investment research for institutional investors, and I started my emerging markets experience in Eastern Europe right after the Berlin Wall came down, and I saw what happened when there was a forced restructuring of countries coming out of communism and trying to become capitalist. And it takes a generation to change the mindset. And I'm watching this very closely in Ethiopia and Angola as well, because they're trying to do something similar, to take the state-led model and flip it over and have it become more of a capitalist-led model. And then I've spent a significant amount of time in Asia, mostly China, before I started going to Africa. That was my job. And the Chinese model was a state-led, very heavily planned with 5-year plans, but those plans were very carefully designed to target specific industries, strategic industries, so that the country could get to a point where it wanted to be in terms of technology, in terms of education, domestic capacity, and then going out into the world. And now we see that happening in Africa. So I know that doesn't really address the question that you asked me, but this is, Africa's not unique in some of the things that they're trying to do. And so I've been going to the continent now since 2007, and I've made more than 50 trips to 16 countries so far. And I publish research, and that's really my core revenue stream is producing research. So I'm continually frustrated with this situation, because looking at it, I'll just give a couple of examples. You would think that if you take away the friction, and friction is an important word for institutional investors, whether it's getting the information and having a hard time getting it, whether it's the trading costs, and then other barriers to investment that come up, whether on a public stock exchange or in a private transaction. And many African governments don't seem to understand that or to care about it. And it becomes, when you start raising the cost of doing business, the returns on capital are going to go down. And that's one of the things that, as I speak to people in different countries, I speak with policymakers, this is one of the things, that I always emphasize, because if you start making it more and more difficult for people to allocate capital, you're distorting the market and taking away the pure returns that could come out of any given business. Another area that I look at this is in privately held companies. If you look at East Africa, many of them are family held companies where you would think that the allocation of capital would be absolutely efficient and targeted, and they would not waste any capital. And in fact, many of these companies are very capital light relative to if you looked at a big European or US privately held company. But there are a lot of other things that get done with capital allocation that are inefficient in terms of decision making, governance on the company. So I think my point is that there are these different things that come in between the overall macro picture and then the reality on the ground. Another example would be companies in Nigeria. If you look at the earnings releases of all the companies that have anything to do with imports, flour mills of Nigeria, Dangote Sugar, Dangote Cement, every one of them references problems with logistics, which are in the port of Apapa, which is a government tolerated barrier to doing business that actually hurts economic growth. So, the capital is there, the good companies, good management, plenty of consumer demand, but the government has tolerated inefficiency in this port. So, it's the kind of logistics barrier or friction that I see all over the continent. So it's a kind of a long way of saying if you may have a lot of capital to put to work, but a private sector investor is going to look at the potential for returns and see that maybe there are other things that they have to take into account. I also want to make a comment on interest rates and currency. And this is something I've been working on and writing about for a very long time. Think about, let's just stick with Nigeria for a minute. Nigeria imports almost everything that it needs. There is a large domestic manufacturing structure, but there are imports involved at every level of that domestic manufacturing. So when you have an oil crash, the country does not have the foreign exchange coming in to pay for these imports. And when you have a structurally weak currency, interest rates are always going to be high because it's the only way that you can really keep inflation under control and attract any foreign capital. But those high interest rates are very destructive to domestic companies. If you are a small company and you go in and borrow, if the risk-free rate is 12% or higher, then you go in to borrow and you're going to be paying 700, 800 basis points above that. There's no way that a private company can make any money with a cost of capital that's that high. So I look at this all as one theme, which is until countries become more self-sufficient or regionally self-sufficient, so they're not dependent on hard currency for imports for a lot of things that could very well be made at home, their currency will be structurally weak, and the cost of capital in that country will be much higher than it should be. So, I think there are some countries that are trying to tackle this. Angola is a great example. Ethiopia is an example, but I think Ethiopia is much further away from having the currency balance than maybe Angola is, but both of them are trying to do something about it. And as they move toward a more open business environment, fewer restrictions on private sector capital, you will see capital come in to invest in that domestic manufacturing to reduce demand for the Forex. So, I think these are some of the moving parts that I look at. I see a lot of excellent management teams, very strong private sector executives and strong business plans. And I think there are the few of these things that could be removed as barriers to earning good returns on investment. And then once you start seeing those returns go up, you'll see a lot more flow of capital coming into the continent.
Thank you so much. I like that you gave like examples and your real work experience, Angola, Nigeria, Ethiopia. Fikra can give more about that. He's from Ethiopia, so
yes.
Talk more about that. Yeah, thank you. You raised important questions. I want to come to Isabel. I know you've spent a lot of time in China and Africa. Want to tell us what's different, like in doing business, like interacting with Chinese companies and businesses and Africa, and what do you think Africa can, learn the good lessons from, Chinese business? Because we see Chinese business all over Africa and all over the world. What's different? What can African business community or governments do kind of different to expand their business ventures across even the world? Why not? Yeah.
Thank you, Enoch. Really, I want to say first that I'm very honored to be among Melissa and Shirk and you. I'm really learning as well a lot about your feedback on those economical questions, and I'm happy to be able to give my very modest contribution. And yes, I've been living for the last 8 years in China. As a Senegalese, I've been doing my own business in Shanghai, and I've been interacting with Chinese companies as well as African companies. So I've been seeing the impact on, the relationship between China and Africa from as well the perspective of the Chinese. So I think as well what brought me to China, it's this exceptional growth that they've been doing for themselves. Because I want to remind, I think in the 60s, some African countries were more developed than China. And China in 30 years came from a poor country to the second in the world. So that was the first thing that really made me willing to go to China and learn this mentality. How did they go from nothing to second of the world? And by also analyzing how they work and how it's going on in China, I can also attract them to be interested in Africa, in my continent. And we could also work together as a bridge to understand better each other and to attract more capital investment and FDI. So I also checked a bit about the figures, and even though there are capital inflow in Africa and FDI, I mean, I'm focusing on FDI, we can see that Africa has much less than any other part of the world. So we have so much, possibilities, because maybe sometimes we see that, yeah, we have capital, why we don't do it, having a big growth like others regions. But we need also to think about the proportion. Comparing to other regions, our proportion is so small comparing to the total FDI in the world. So my role, and even I think entrepreneurs or people like you guys, is as well to improve the attractivity. Because what I've been seeing with Chinese investors in China, there is a lack of transparency, and there is also, Africa is not one country. So they are also confused. Where should I put my money, right? Should I go to Ethiopia? Should I go to Senegal? And we can see that the investors are more interested, of course, by the leading countries like South Africa, Kenya, even Ethiopia as well. I saw that we were talking about this, as well as Nigeria, because they also look on the local size of the market. Because I realize when I'm talking about Senegal, people in China are very interested and say, okay, what is the potential of Senegal? How many people do you have in Senegal? And then when they see that it's not even half of the population of Shanghai, they tell me, okay, they're already kind of not interested. So I think one of our problem is as well to not being global. It means to think only about small, for example, as entrepreneurs, we do a business and then we only focus on Senegal, let's say. So comparing to this investor that come, they want a broader perspective. Maybe they want the CDAO, all the free trade zone area, but we are also limited by infrastructure. We are also limited by, how to move those goods, how to do business between each other. And I was looking as well on figures that says that Africa doing business, doing trade with Africa is only 13%. All the rest is, with the rest of the world. So there is as well a super potential. And another study by the World Bank says that if we just renovate all the existing roads, like renovate it, like upgrading them, it could bring 500 to 1,000%, increase of business. So that's actually, we see outside, but there is also a lot of potential inside to give more, to be, for making us more attractive to those capitals, and as well as maybe having a kind of a global strategy to straighten each country as a whole to be able to attract those investment.
Yeah. Oh, thank you so much, Isabel. Like you bring important points. Like Africa does 13% trade between Africans and then the rest of the world. That's something to explore more. You know, I want to tap into, you know, you bring a China model, how China was 40 years ago and now what China is. Everyone, I guess everyone knows about that, how China is now. But I want to draw more like Melissa, you talked about the challenges like most African governments have. I want to go back to where, as an economist, what are the structural challenges that limits or impedes attraction of these private capital flows? I want to look at in an angle of an economist. What can we do better to attract more capital flows? As many people have said about the challenging structural plan, but I want to tap more into, what do you think?
Yeah, I think it's important to kind of distinguish between two kinds of capital inflows, right? The first one is a risk-sharing kind of capital inflow, like foreign direct investment and equity, where whoever is investing is actually sharing in the risk. If the investment does not pay off, they also take a hit, right? And there's another kind of capital inflow which is not risk sharing, like bond, for example, right? Where it doesn't matter if the investment pays off or not, you have to pay the money back as a country, right?
Uh-huh.
And the observation tells you that these non-risk sharing kind of capital inflows, like the bond, tend to be very short-term kind. They're very erratic, they're very unstable, and they tend to be short-term, right? But the risk-sharing kind of capital inflows, like the foreign direct investment in equity, they tend to be long-term. They are kind of more stable, right?
Yeah.
And going back to what I said before, saying that we do not really see in the data a relationship between capital inflows and economic growth. And that's particularly true for the short-term kind of capital inflows like bonds. And there is a reason for that, which is that when a lot of capital comes into a country, when capital surges into a country, its currency tends to appreciate, right?
Yeah.
And what that does is that your imports become cheaper and your exports become more expensive, right? So it's undermining trade competitiveness here, right? So the efficiency gain that can come from allocating capital efficiently can be overturned by the negative side, which is that trade is not competitive anymore, right? But if going back to the first kind of capital inflow, the foreign direct investment and the and equity, if they're handled well, if they're complemented by regulatory frameworks and good institutions, they can actually have a positive effect. That's what we see in the data. And there's some, there are two other, I think, important problems here. One is that, especially the second one, the short-term kind of capital inflow, tends to really lead to unstable kind of economies, financial instability, at least through three channels, right? The first one is when capital comes in and out of a country, the currency tends to fluctuate with it, right? That's called the currency risk, right? And the second one is when investors perceive some kind of risk in an economy, they tend to sell their asset in mass and leave, right? That's called investor flight risk, right?
Yeah.
And the third one, which is, I think, very important, a lot of people know about it, is it's a contagion risk in a very interconnected global economy. When some risk happens somewhere, it tends to bring the global economy down. We saw it in the 2007 financial crisis, where a problem in the US housing market brought the entire global economy down. And that's what happens when you allow capital to move very freely. A certain crisis somewhere can bring everybody down, right? Okay. And there is a third one, which is, I think, very important to keep in mind, which is that capital inflows, especially the ones where it's short term, tend to undermine democratic kind of decision making. What I mean by that is it gives an undue kind of political influence to external speculators and organizations like IMF and the wealthiest group at home, because if you want to attract capital and if you don't want it to leave you, right, then you have to follow what they're telling you. And a lot of African countries struggle with that sovereignty issue, like making sure that the policies reflect what the majority of the people want, as opposed to what external speculators would want, or what an organization like IMF wants, right? Yeah, so there's these, three problems. I think, I want to relate it to why I think, capital influence did not have, the kind of effect that we thought they would. But that being said, coming back to your question of, what can be done to attract more capital, and I would even correct that question to say, what can we do to attract the kind of capital that helps, right? The kind of capital that has a good effect, like foreign direct investment and equity. And one thing you can do is, macroeconomic stability, making sure that inflation is under control, making sure that the government deficit is not out of control, right? Capital does not go into places where there's inflation is crazy, right? Like a country like Zimbabwe, where the inflation is sometimes 1,000,000%. Capital will not flow to these countries. Capital will not flow into countries where the government hasn't gotten its budget under control. The second one is political stability, which I think is very important. Capital is not going to go into countries where there's a security problem. A lot of African problems have security issues. Peace is usually a problem. There's usually conflict, right? Making sure that there is peace and security is under control is a good way to attract the kind of capital, long-term kind of capital, right? And the third one, I think, even more important is you need to have good regulatory frameworks and good institutions to back it up, right? And here I want to stress, saying all the things that I said about the negative things that happen when you bring capital. I think there's a role that capital controls can play here. One way they can take, for example, one form that they can take, for example, is you can limit the amount of capital that can leave a country at any given time, right? And what that does is it kind of mitigates the instability that comes with capital inflows and outflows, right? And the second advantage is what we see from the data and the evidence is that when they are done correctly, capital controls tend to change the composition of capital inflows from the short-term kind of capitals like bonds towards more long-term and durable and more stable kind of capital inflows like foreign direct investment. And here I think it's important to stress that there are not one-fit-all kinds of capital controls. What works in a certain country is not going to work in another country. So that requires experimentation, that requires knowing a local context. But once you get it right, I think there's a good evidence to think that they have a big role to play.
Thank you, Fikr. You speak of very important questions and the point of political stability, peace, and that's why at African Rebirth our motto is peace, unity, and prosperity. So we can't achieve anything without that. But you speak also an important question of democratic institutions and how these big institutions like IMF and World Bank have influence on economies and influence policy. So I want to bring Melissa in. You sit on the Bretton Woods Committee, which is a very big institution, and I'm very sure that you know the structure, the World Bank system and the IMF. Has it occurred to you in your research that you've seen this, external influence over economies more than the local, policymakers or politicians want how to drive the economy, and their external influence have a bad effect on the economy? Has it occurred?
Yeah, well, first of all, I was just appointed to the Bretton Woods Committee. So next week is the IMF World Bank meetings, and we have calls and executive sessions. So you can ask me about it after I've had a little more time with that. But yes, in my regular course of work, I do. I always meet with IMF wherever I can, and I have met with many World Bank offices during my travels. And I mean, I'll just make a couple of comments. I think you're correct. I think sometimes if you look at Angola, for example, where there has been, in my view, the correct political move. I think the new president, he's not so new anymore, but he has the right agenda. He's doing the right things. I do feel the right sense of urgency from different ministries that I deal with, which is not the case in every country. And there are things that are outside of the government's control that are affecting their budget and their ability to attract investment. And I think there's been a real struggle with the IMF wanting to impose austerity or force them to cut back spending on things that would otherwise lead to long-term development if done correctly. So I absolutely agree. And I do see that as an issue. I think a lot of it is a function of maturity of the different government institutions. And I think, education and bringing and doing what you can to attract the right people into government. But you also need a stronger corporate sector. And again, this is a matter of time. It's a matter of diaspora coming back and bringing experience. It's a matter of bringing in the right education to people in a given country. And, I look at all this as a function of incremental steps. And in general, what I see across the continent is governments moving in the right direction. I do see entrepreneurs getting lots of support and education. And I am seeing, really out of necessity, some of these family companies that are poorly governed being forced to acknowledge that the world has changed, and if they want to stay competitive and stay viable, they have to change their governance. Otherwise, that private sector capital is not going to come. But I think the democratic controls, sometimes governments do the right thing and sometimes they don't. I mean, Kenya is a very exciting country because of the vibrancy of their technology industry and some other innovative things that have happened in the country. But a lot of my advisory work is in the rail sector. So Kenya built a standard gauge railway using Chinese money and Chinese operations. And they had 3 solutions they could have picked. And the World Bank offered advice. They didn't tell them what to do. But Kenya picked the most expensive. And then you started having increases in corruption and increases in land costs. And the budget for the standard gauge rail project ballooned out of control. And now it's like a millstone around the neck of the Kenyan taxpayer. And so the government made their own decision. It was done out of the ministry and the presidencies and wherever. So, you can lead a horse to water, but you can't make him drink, is what they say. So, I think Kenya does pretty well in attracting FDI, but they could do even better if there were a more disciplined capital return philosophy inside the government. That's a consistent problem everywhere in the world, not just in Africa. Politicians want to get reelected, so they do something that shows big moves and quick returns, but it doesn't always work out that way. Did I answer your question?
Yes, you touched on, you really answered it. Yeah.
Okay.
Yeah, I'll come back to you. Let me go to Isabel.
Yes.
You advise like young African startup businesses and connect them to global opportunities. Are you cautious of like external influence, and because you can start a business by, if it doesn't address the local problems, do you have like a way to address them and have like addressing more local problems and maybe boosting local revenues, other than like connecting them to international firms that could even be taken over and influenced? Do you do that? What's your take on that?
Thank you for this question. Yes, we try. I'm also a young entrepreneur, but we try to change our mentality. not waiting,
Yeah.
you know, that someone is coming to help you or someone is coming to give you all solutions, or, you know, waiting that the economy is getting better, you know. So we wanted to encourage this entrepreneurship and African entrepreneurship, because I've been living in Shanghai for the last 8 years,
Yeah.
and most of the events, the pitch competition, etc., we can see companies from US, from France, from Europe, etc., getting actually a lot of investment in China. And we were just thinking, okay, why not doing our own event and opening it to all the African entrepreneurs or Chinese entrepreneurs who want to do something with impact in Africa. And thanks to our network and really a lot of people I want to thank today that volunteered their time. So it was investors, coaches, and all of our community there in Shanghai came together to realize these events. And what we notice is most of Africans, when they're coming to China, it's actually students. And when you look at the statistics now, for African students, I think France is #1 for students, like African students going abroad. And then now you have China, #2. So we can see that all those students that have been in China, maybe only 2 to 3, 4 years, they're still a bit connected to Africa. So they still address the problem of Africa when they are giving to us their projects that they started. Some of them are only in an ideation stage. Some of them are more advanced and already started something. Some of them also don't have actually solutions for Africa, but mostly solutions for China. But we believe when we give them the opportunity as well to train, to do a business in China, they also will get a lot of knowledge, and that we can transfer this later on in Africa. So our goal is as well to gather all this energy, all this youth that in general, like us before, were just, you know, dreaming about doing something, but never had the opportunity to make it happen. And we want those people to know each other. It's as well to create businesses in the future that will go beyond only us in Senegal or only people in Nigeria, you know, because in Shanghai, we have this opportunity to meet Africans from all over Africa. So it's a good platform actually to see those people, you know, you leave your country and you are so optimistic to go in China, you don't know the language. After 6 months, you speak Chinese. So those people are so inspiring. And our goal is to give them the stage and the investor can see. And, you know, it's a small scale, but it's also building up the trust that we need for this kind of investment, you know, people getting interest in our countries, people getting interest in Africa, and boosting entrepreneurship, I think, is the first gateway. And to reply to your questions, of course, we really want to make the accent on helping in Africa to boost the economy in Africa. So addressing problems that we do have in Africa. So this will be, and it is actually one of the criteria where we will choose which startup will win, because we really want that the project has an impact on Africa. So we also direct them to thinking more about what problem can we solve in Africa, and why not as well matching up, because we can see a lot of African entrepreneurs, they have projects, for example, digital products that look like similar, and they are from different countries. So we also help them to connect. So through the platform, they can meet each other and, you know, exchange knowledge and maybe making something big. And as Melissa said, it's incremental. So it means it looks like a small step today, but in 10 years, in 15 years, you know, what can happen with them? It's like, it's an infinite possibility. So we want to give this, you know, this boost, letting people starting where they are, because of course, we need to start somewhere. We cannot just start and having that big company and managing those big things and changing the governance, etc. But we need to start from there, and giving the opportunity, I think, to do those in entrepreneurship projects can lead to solve problem, because we can see as well how Chinese solve problem here digitally, and people getting the knowledge like through transfer of technology. And also, I will just finish there, with manufacturing, because as you know, in China, there is a lot of machinery, and we didn't yet really get into this industrialization stage in Africa. So there is a lot of cooperation possible between Africans and Chinese to actually do our own manufacturing and address making products for the local market and boosting this trade within Africa.
Yeah, thank you. We just wrapping up with time. We're running up with time, but I can't we can't finish without the way forward now, the strategic way forward from each one of you. Then we'll come back to for our audience if they have some questions, the Q&A. I believe they have burning questions or contributions. So starting from Fikre, what's the way forward? What should Africa do best? What should Africa do different? Isabel was saying, like, in 40 years ago, African countries were the same like China, but where did we go wrong, and what should be done? Way forward, real quick. Yeah. You muted. Yeah, you muted, Fikre.
That's a $1 trillion question right there. To be honest, decade after decade, economists thought, they have actually found the magic bullet that's going to solve the problem, and most of the time, they're proved to be wrong. We have made a lot of progress over the decades in terms of understanding why growth happens in some places and why it doesn't happen in others. But in retrospect, everything kind of makes sense. You see China has grown now, and you say, okay, it's simple. They grew because they did this and they did this and they did that. And you see a lot of African countries, and you say, they didn't grow because they didn't do this and they didn't do that and they didn't do that. But if you like the models that we have right now in terms of predicting where growth will happen and when it will happen and why it will happen, they're still very deficient, to be honest. But that being said, wherever growth will happen and whenever it happens, it's going to require manpower and it's going to require brain power, and we know that for a fact, right? So any kind of investment in human capital, in terms of making sure people are educated and making sure that people are healthy, can go a long way. And even if it's not going to be economic, there's a moral case to be made for that. Okay, economic growth hasn't happened. I educated my people and make sure that people are healthy. Economic growth hasn't come, but there's a moral case to be made. There's an inherent value in making sure that people are educated and people are healthy, right? So while we wait for the growth to happen, I think make sure that people are educated, make sure people are healthy, and I think you can never go wrong doing that.
Thank you, Fikre. People, human capital, people educated, healthy. As we wait for growth, I wonder how many years we should wait, but we'll wait. Educated. Yeah. So Melissa, your experience on the continent, 15 years of trips, have you seen changes, or what should be done better in relation to the question I asked?
Yes, I've seen changes for good and changes not for good. And I was just thinking of, I'm going to make 4 very quick points. First of all, African governments need to have a broader worldview. They need to understand what's going on in the world, how things are done in other parts of the world, and that Africa is not unique and needs to be part of the world. The second thing is, country by country, things can be so different. If you compare the Rwanda Development Board and the impact that the business-friendly and strategic thinking of the Rwanda government has done for growth and prosperity, you compare it with a country like Cameroon, where the government is in your way every single step. I have a friend who's trying to do inland fish farming, which is a wonderful business. I've been to Cameroon with him. We've been in to see ministries, and they are in his way at every single step, and he still doesn't have it working properly. I think the Continental Free Trade Agreement is a game changer, and countries need to get on board with that, because if you can be competitive in your manufacturing and your services output and produce something that's high quality that will sell in other countries, you're also selling better for your own people. And so barriers to trade and barriers to competition are very bad. So I would encourage the continent to push as hard as possible to deal with all the non-tariff barriers and the things that could hold that back. And then finally, just to follow on what Fikram was saying, you know, the hard infrastructure, I mean, this may sound crazy, but that's the easy part. We know how to build bridges. We know how to build roads. It's the soft infrastructure, not just the education and the well-being of people, but the experience and the knowledge and the creativity of the young African people needs to be channeled and supported and developed. And that's when the continent will take off. If you'll have so much power in the private sector and young people that the governments will not be able to stop them.
Yeah, thank you so much. You talked of, Cameroon, like taking the whole 1 year. We have a friend of ours also was doing business in Cameroon, but it took him 2 years to get a working, like verified working permit. When he came to Rwanda, it took him 2 hours to his business to be registered. And
Yeah.
like, I've never seen this. When you speak of that, I really understand, like, going back for bureaucracies.
Yeah. And the amount of energy, the amount of time and energy that's wasted.
It was wasted
It's
time.
criminal. It's criminal. Anyway, don't get me started on Cameroon.
Yeah, thank you.
They have a lot of work to do.
Right. So Isabel, how about you? What should be done? What's should be done?
I'm very inspired by all you said, guys. And I also would like to say, sometimes we think that we can go to economic growth from today to tomorrow, it's a marathon for me, and it's not a race. So we must learn as well to make those things that are very important first, because sometimes we just want to jump in the last stage, of the economy, to compete in the last stages of things with others, around the world. But we forget that we don't have any infrastructure. Like we don't, like most of African countries are still not linked by rails or by roads, even by air, So we want to make this race, and we don't think even on the base, So maybe to slow down a bit, thinking more globally, thinking like a marathon, giving, the roots first, like let's build the foundation of this house that we are forgetting. And that's how also I think we could collaborate with the BRI, because it's also, looking on those things, infrastructure, logistics. I think this is the base to start with, and accepting that we are as well in a learning curve. And yes, it takes time, but it doesn't mean that we are not in the right direction, right? So we need to be patient. We need also to trust in ourselves, having good partnerships, not, for example, just China or just US or just, Europeans, like knowing how to work with different parties, and knowing as well what we want from the relation, the relationship, starting with the foundation to be able to have economies that can sustain in the long run. And like Fish said, not just something, quick, and then we just have all the consequences behind this, because sometimes government, just like Melissa said, just want to have a short-term impact, and then there is nothing in the long run. So we must think about what do we really want for our continent, and being willing to go for the small steps to start, to have a broader view. And as he said, also the human capital is very important. There is not only economic growth to be measured to know if a country is going forward. Access maybe also to boost, and the last point for me is to boost entrepreneurship. I think this is very, very crucial, because it helps people to put as well their creativity. Because if only, let's say, a government is thinking, okay, all the population is relying on them. No, we also, as a population, when we are, empowered through lower interest, maybe to be able to lend money from the bank, for example, to also input what we think about how can we improve our own country, because we know what are the real problem, right? So yes, I think actually I'm very positive about Africa, and I think we are really on the good way. Now let's also do things that matters.
Thank you so much. We're on the right path. We just have to galvanize the engine to reach where we want to go. Now, for sure, thank you very much for your submission. Before we end, I think the audience might have some questions. Is there anyone with a contribution, a question, a follow-up? This is your time. Anyone? Or you are fully convinced about this? It could be the point. It could be also.
Don't be shy.
Yeah. Anyway, maybe there is no question. People are fully convinced about that. I know some, like Melissa has other commitments shortly before after here. I want to sincerely thank you very much for your contribution and accepting my invitation to come and participate. It's incredible and immeasurable. Just like Melissa said that going to Cameroon takes 2 years, to approve your business or wherever, and you go to Rwanda and they quicken. I must say that my invitation was so quick. So I see like was quick and the reply was so quick. I really love that. And it shows that you are also good at doing business. I really appreciate that. Thank you very much. If you have your last comments, something to say, you can say it now and we can call it a day.
I'll just say thank you for this panel, because I've really enjoyed this. And anyone who's listening to this who wants to connect with me, I always accept LinkedIn invites. So happy to continue the conversation in any way that's necessary. And I can't wait for COVID to be over so we can get back on planes and go see people again.
Yeah. Thank you, Melissa. Thank you so much.
Yeah, thank you, Enoch. These are very important conversations to have. Very, very important.
Thank you. Thank you, Fikri.
And thank you, all of you guys, for your input. I think it's very inspiring. I'm looking forward for more events of African Rebirth and more interactions with you guys and also with the audience. Same, you can find me on LinkedIn if you want, and I will be happy to pursue there.
Sure.
Thank you.
There's one question here for Melissa. Like, does Melissa know about the Young Africa works that MasterCard Foundation is doing?
I don't know about that specific one, but I know MasterCard Foundation is very involved.
Yeah.
Is there a specific question about that? I'll take a look at it.
Kay, someone called Kay, would you be bold to ask a question, or you can type in a question, I can read it for you. Either way works. Oh, just sharing info. Okay. Oh, her mic is not working, or his mic. Sorry, I think. Okay, but it's something we can explore and research more about that. Definitely.
Yes.
Someone like
yes.
Involved with the content, it would be nice to check it out. It's called Young Africa Works, partnered with MasterCard Foundation.
Got it.
You can really look it up. And yeah, so thank you so much. It's been a wonderful panel. I am educated more. I'm not an economist by training, but if it was an economist tomorrow, I would pass it with an A. So I'm really yeah, thank you very much, and have a very good day and happy Sunday.
Thank you.
Thank you.
Cheers.
Enjoy the rest of your weekend.